trading starts. Rohit Srivastava is here with us. Thank you so much for joining us, Rohit. Nifty. Now today it appears that it'll open around that 8780 kind of level, and then could go about to 87, 8728 today is the third resistance, and then we don't know, 8750 probably. Is that a key sharp resistance that's going to be difficult to cross?
I think the major resistance would come in the gap area, what most technicians will call an island, which is between 8824 and 8848, because the market had gapped up there a week back and then it gapped down there a week back. So that's the price territory in which basically there has been no trading that has taken place, and it typically acts as a resistance zone on the way up. And if you get past that, then that's where you would actually change your near-term bias to being a little more positive. So I think that level is a little more far away, but that doesn't mean you have to go there or will go there. 87, 80, like you said, is the first level I think everyone will be watching. So we'll see whether that holds or not.
But in terms of your overall sense of the markets, are you taking a pause right now?
Well, it has taken a pause, and it would have looked like, that you're starting what could be a slightly steeper correction, but we haven't broken all the key levels required. For example, both the Nifty and Bank Nifty are above their 20-day averages, which around the world, if we actually looked at most indices, most of them actually broke past these levels. So our market is actually still holding on to that, which can keep open the doubt or possibility that somehow if we do see some kind of a global recovery into next week, that our market can again try to test the highs. So that possibility remains open. Though if you ask me what's the primary view, we would probably think that we've topped for now. Maybe we can dip lower, and this
I'll have
will be a
to just
short-term bounce back.
come back to you. Pankaj, why don't you take over? The markets have opened. Now, obviously, we have just about 3 stocks left in the top traded counters, which are in the red. Rohit, before I move on a little bit more and ask you about what your view is about global markets, I just want your views on 2 counters, TCS, in terms of technical itself, and Reliance Communications. Are these counters that are even worth looking at the moment?
Broadly, I would not think so. And we do have exposures to TCS, so we've been generally negative there, and probably that would continue. Because my sense is that over the last year or two, the highs that TCS saw, we've only made retracing rallies, and then sold off again and again, and that's generally spread to the rest of the tech sector. So I don't think, TCS not only standalone, but the entire IT sector, I think, would remain under pressure.
So let's pull up the Nifty intraday for you, because we did hit 8800 just a short while back, 8802, and as we mentioned, that 8800 will become a psychological barrier, even though the intraday itself, the daily technicals that we show you based on yesterday's high, low and close, that indicates that if you move above 8780, then you should be able to move above the 8800 and move towards 8828 levels. But 8800, it's a psychological barrier, but it is sticking around that place. So after some time now, after those 2 huge corrections, we have regained 8800 after, I would say, I think 3 trading sessions. This is the 4th trading session after that huge correction, a huge drop that we saw on the 12th of September. So that's what the picture is like. Rohit, in terms of these round numbers, 8800, 85, 850, do they, even if your charts don't show them to be areas of resistance or support, do they psychologically become numbers that traders work with?
Over time, I think that has happened, because a lot of people are watching the options data, and the options market is at every 100 points where the maximum open interest tends to build up. And therefore, people do look at it psychologically as the positions keep changing, though they don't show up as chart levels exactly at the round numbers.
Okay, right, exactly. So the options has that impact on that number. So 8,800 is just we're touching it and going down. But let's see if there can be an upward movement, then maybe 88.28 as we were talking about on the daily basis. And that's the one to watch out. The Dow. Now, we've been seeing, we saw a minor correction one day and then it bounced back. How are you reading the Dow right now?
It was at a very critical level yesterday, because if we just draw a trend line right from the bottom of the Feb low that the Dow made, that's exactly where it stopped yesterday and turned up. The critical factor, though, for the US markets is going to be the bond yields themselves, which saw a significant jump up. And this jump up has come after, a long pause, because, we saw the first jump in yield somewhere in June. And after that, throughout August, the yields were flat. They didn't go down again. And then this is the second time we are seeing a further rise in the yield. So that essentially is what we would call a third wave, and usually it's more meaningful and where you get the maximum market impact. So we are beginning to see that market impact on a day-to-day basis. It's very hard to say that yields have bottomed and will turn up here, though you generally expect, well, if the Fed does nothing, next week, then the yields would probably start to drop again. But bond markets may continue to do their own thing. So I think you'd want to pay attention to what these bond yields are suggesting, because the Fed itself, even whether they do something or not, has continuously suggested yet that, rates would eventually go up, and the bond markets may start reflecting much more of that, because they've also reflected much more of easing over time because of a lot of money that went into bonds. So bonds were actually rising, and the 30-year bond actually made its highest price point it's all-time high level, sometime earlier this year. And in that sense, this move might be more meaningful. So I think you need to pay attention to the bond yields in the US, and any further move up on that would continue to put pressure not only on the US, but most global equity markets. So that's going to be the most important indicator.
In terms of volatility itself, if one looks at the chart, the candle chart of the Dow, then for almost 2 months, from the middle of July to, let's say, the beginning of September, first week of September, the candles are very short. The range is very short. But now, in the last few days, we're seeing these very long candles develop. What does that indicate?
The best way to look at that is look at the wicks, and the US wicks had fallen to its the lowest levels that it has seen over a 3 or 4 year time period, and each time it's fallen that low, we've always seen a jump in volatility. So the US VIX actually jumped up over the last couple of days, and clearly that means that you're seeing a trend in volatility that could continue, and so when you start off from a low point, you'll probably not just reverse in a few days. You'll probably see much more volatility before it reverses. So my sense, purely looking at the wicks, is that this round of volatility is not complete. You've just started, and there should be more ahead.
Okay. In terms of crude, in fundamental terms, we've been getting completely confusing numbers from the US. One day you hear that the crude inventories have gone down to levels which are last seen in 1999. The next day the inventories pile up. One day you hear petrol, diesel, heating oil inventories are down. Next day you hear that they've gone up to a 8-month high. But technically, what is it looking like? Where does it settle? Is it going to weaken further?
Yeah, it's interesting, and you need to look at both aspects. See, technically, my sense last month was that we would have peaked at $52 and started to sell off, and we did, and then we got this bounce back. But we have still not gone above that mark. So my sense is we remain on a downtrend. I don't think we'll go above 52. We are bouncing around between, the $40 and $50 mark for a while. But my sense is you would eventually head lower to maybe somewhere closer to $35, $36. Will you go even lower than that? I'm not sure whether you'll go lower than that right away. Maybe on a 6-month basis you could. And the interesting things that you hear, apart from just the day-to-day inventory movements, what you should be reading into is that a lot of oil producers have actually started to use, better technology, which has brought down the cost, which, for all these shale manufacturers was, used to be that, if they are below $60, they would be losing money. Now they've managed to bring down costs to, closer to $40, $45, and that's actually makes things a little more positive, which is why you're not really seeing panic when oil actually drops to these levels. And probably you will see that only happen when oil falls, below 40 or below 35 is when it would really start to hurt.
In terms of
and
pricing,
then these day-to-day inventory numbers.
Rohit, one of the things that we had heard is that earlier, unless it had gone above 40, above 50, a lot of these shale oil producers did not, it wasn't worth their while to start producing again. And therefore, there was worries about bankruptcy. Now you're saying that around 45, 46 itself, they will start producing. Now that means, and even refineries come into play right at that point, then that kind of also puts a top to any possible price increase as well, right?
That's right. So which is why the upside is likely to be capped. It could either remain range bound for a while, or at some point of time, you could actually see more downside.
So you actually feel that it could go all the way down to 36 odd? Because I was reading a report which said that around 43 odd, there is a significant amount of support for the WTI. You don't believe that?
No, I don't think it's significant support at this point of time. I think it's better to look at it as the upside being capped rather than, the downside being capped. So,
all right. Okay, but that brings us to the idea about what is, one of the newspapers, and I was looking at your own picks today and your cues that you were saying, aviation. I saw that on the front page of the Mint today, that aviation counters are doing well. For the first time, probably, it reverses what Warren Buffett used to say, that if I think of buying an aviation counter, aviation stock, I call up Aviation Investors Anonymous and they kind of tell me, no, don't do it. The oil prices have completely changed that, right?
For the time being, it seems to have it might be a thematic play, and we saw it do well also in the October to December quarter, when oil prices were also falling at that time much more steeply, and the airlines actually did well, and after that they've been consolidating, so they're not really selling off. You've seen a consolidation in the prices of maybe Jet or SpiceJet, and that's gone on for several months. And my sense is that, as oil prices again come under pressure, that's been one of their major cost factors, which is helping their bottom line pick up. They would probably break out of this consolidation on the upside. So we are somewhere at the lower end of that trading band in some of these stocks, which is why we are looking at, the bullish possibility for the airline stocks.
I know you essentially look at prices rather than fundamentals, and you look at charts rather than fundamentals, but I'm going to pick your brains because I know you have views about the economy overall. You have view about which way things are picking up. What is your sense about what is happening? We've been talking about a recovery, we've been talking about things, but data points that you look at, what does that tell you about India?
Well, when you look at the economy, we're typically looking at GDP numbers, which are talked about most, and the idea that, it's not reflecting in things like the IIP. But what's most important to markets at the end is whether all of that translates into earnings.
Right.
And when it comes to earnings, you can either look at earnings growth for the index as a whole, or you can look at the fractured earnings growth. So what a lot of funds have started to do is simply say that, well, the index does not matter. There's just 20% of the stocks which are showing some growth, and let's focus on that and let's ignore the 80%. And that itself does not really reflect well for the macro economy, because if all the sectors are not performing well or growing, for whatever reason, whether it's top line or bottom line, it's interest costs and debt, which I believe is the biggest issue, that there's a lot of debt outstanding for the corporate side. And unless they're able to come out of that, you will not enter a fresh growth cycle for the market as a whole. So what money ends up doing is chasing these few stocks that are growing, driving up their valuations to levels where it no more makes sense from a very, very long-term perspective. And by very long-term, I mean someone who wants to buy and hold maybe for 5 years or 10 years. there have been enough studies to show that, if you buy very high valuations, your long-term returns are typically never good, or
Right.
sometimes they can actually be negative. So in that sense, we've become an overvalued market because we don't have earnings growth. Most people thought that after the April quarter, you would have turned around. But again, for this quarter, if you take the Nifty as a whole, we are still growing negative. But if you remove components, which is what most people do, is typically you remove some components and say that, we are only covering these stocks and earnings are still growing. On a macro basis, I don't buy that argument. I mean, it's fair if you're a stock-specific picker and, you only buy a couple of stocks, or you're exposed to only, a smaller portfolio. But the moment you're investing in a diversified portfolio or in a mutual fund, the possibility of long-term returns becomes rather difficult.
Is that especially true, the point that you were making about buying stocks at a high value and then the long-term returns might even be negative? Is that especially true about mid-cap stocks?
It is. It has become because mid-caps have become the best performers of this period. People have chased up stocks which were low-lying. Some of them were undervalued, but many of them have, may have become overpriced. There might be areas where there is long-term growth. So you'd really have to do that stock-specific analysis in terms of where you want to be. But like I said, when you overpay for something, even if there is long-term growth, you can take an example of, say, even Infosys,
Right.
and you go back to, the tech bubble. It used to run at 100 times, and people would say, well, it's growing at 100%, so you have a PEG ratio of 1:1, so it's normal. And today you're paying for some stocks that are growing 30%, you're paying 30 times or 50 times.
Right.
The moment you're paying more than the 1:1 ratio, if there's any change in the growth path, even if the stock continues to grow, your returns from the stock price could change significantly. I mean, if you just look at Infosys, it took more than a decade to really come back to that price.
Right, absolutely.
So that's what tends to happen.
So I'm specifically asking this question because there are a lot of stocks which were the darlings of brokerages, of investors in the 2006-07 period, and they've probably disappeared right now. There are some engineering counters. They almost don't trade because a 100 rupee stock is probably selling at 20 paise. There are counters which had so-called new energy or photovoltaic cell makers which went up dramatically, and then they've disappeared. They don't just exist. They've changed their names. Is there a problem like that developing right now in the mid-cap space as well?
Sometimes it's hard to say at a point of time. In hindsight, it would be visible because if you have hundreds of mid-cap stocks that are looking like the darlings of tomorrow, it's definitely not possible that all of them will be there. There may be a few that might actually make it in terms of having a business model that would continue to grow and compound. But there could be many others that have shown near-term growth and might not be able to sustain it. So that's the big risk that that kind of scenario can repeat if you are really not sure or not careful about where you are. And many thematic plays, say for example, last year I had a thematic play with something in sugar. So if you have a thematic play, and like right now we are talking about airlines.
Yeah.
They're good for a couple of quarters, they're good for a year, but they might not be good for 5 to 10 years,
Right.
because the theme itself might change or might, get overpriced.
So what I'm hearing from you is that right now our viewers should actually be, short-term investors, maybe swing traders, maybe staying in for 3 to 4 months, tracking prices, and not say, I've bought it, now I'm going to look at it 10 years later.
I think they should all have a mental level in terms of what would make them uncomfortable, and if you reach that level, then yes, you should look at booking, moving out, and managing risk. I think managing risk actively is very important, especially at the levels that we are.
But in February, you would have said ideal time for long-term investment? I mean, if you're picking the right stocks.
I would have said it was a good time to take the trade for a couple of months. I didn't think it would go on for 6 months. I thought probably that move that started from the Feb low would have ended by May, and it's gone on June, July, and August. So I didn't personally believe that it would have gone on this long, but it was essentially a trade. I didn't look at it as a start of a long-term move. I still don't certainly think so, because I think the macroeconomic problem, which is the debt ratios, and which have got skewed more in favor of the private sector versus the public sector, which means the government has brought down its debt levels over the last decade, and the private sector has continued to take on more leverage to grow. That has not corrected itself.
I just want to again pick on your experience. You know, a lot of investing has a lot to do with sentiment, anticipation, one's own mood at a particular time, or one's own sense of fear or greed, right? If you look back, in 2007, when there was an anticipation of a correction in the beginning, we saw a mild correction, and then the markets kept going up. And in those days, a lot of people used to tend to track the Sensex, and all business channels used to talk about Sensex, because we were not talking about trading on an index. We were looking at just the sentimental level. And I think somewhere from the middle of 2007, a lot of people started talking about the shallowness of the Sensex rise. But were you worried at that time? Just look back. Were you as worried at that time looking at the markets as you are now? Or are your worries more because of what happened in the past?
Well, the way I'm viewing today's market is closer to where we were maybe in the year 2000, because the one business cycle that I actually lived through was the 90s, from 1992 to 2001, and I see a lot of similarity to what has happened between 2008 to date. In terms of how sectors behaved, how different sectors which were the favorites of the previous period really sold off big time. Then thematic plays continued into 2000, and then once you had the tech bubble, then everything unwound from there. And then actually the business cycle shifted back to the core economy, so that was the last phase.
Right.
So I think somewhere we are in the last phase, but we've just not reached that end point, because so many sectors have already done badly, and we've shifted to thematics and overpriced them. We are at the fag end of this cycle, because 2008, 2016, like it's 8 years. The only thing is we've not addressed certain issues that are necessary to really kickstart a proper bull market that can, take us ahead. And I think somewhere, I think 12 months, 18 months more, you'd probably see that getting addressed. I mean, there are a lot of steps, baby steps that the government is taking. So it's not that they're not moving in that direction, but we've just not seen it play out, so it looks like it's going to take a lot more time.
And unfortunately, by the time you reach that, tough decisions are going to get more and more difficult, because you're going to come close to general elections. Thank you so much, Rohit Srivastava.